Hello everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're putting a specific company under the microscope, WLDS, Wearable Devices Limited. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about WLDS, or Wearable Devices Limited. This company operates in the technology and consumer electronics sector with a current market cap hovering around $5.09 million. What do they do? Wearable Devices Limited is pioneering some pretty cool tech. They're developing a non-invasive neural input interface that allows you to control digital devices using subtle touchless finger movements. Think about controlling your smartwatch or other consumer electronics without actually touching them. Their modular development kits are at the forefront of this innovation. Should chart WLDS 30-day price action. Looking at the recent price action, WLDS has been quite active. While it's down 5.44% today and 7.93% over the last 5 days, zooming out to the last 30 days reveals a significant gain of 63.27%. This kind of volatility is often seen in smaller cap companies, especially those catching the eye of short sellers. What is cost to borrow and why it matters? So, what does it mean when we say a stock is hard to borrow, and why does that matter? When someone wants to short sell stock, they first have to borrow shares from an existing owner, usually through their broker. They then sell these borrowed shares, hoping the price will drop so they can buy them back at a lower price, return them to the lender, and pocket the difference. But borrowing shares isn't free. There's a fee called the cost to borrow, or CTB. This fee is paid by the short seller to the lender. When a stock is hard to borrow, it means there's a scarcity of shares available for lending, or very high demand from short sellers. This scarcity drives up the cost, which is typically expressed as an annualized percentage. So, a 100% CTB means a short seller is paying 100% of the stock's value per year just to hold their short position. These fees can skyrocket well beyond 100%, indicating extreme demand or very limited supply. Why this stock is hard to borrow right now. Now let's apply this to WLDS. This stock appeared on our hard to borrow screener for a very specific reason. Its annualized cost to borrow fee is an astonishing 720.0%. That's an incredibly high percentage to pay just to keep a short position open. With an estimated float of only 1.9 million shares, any significant short interest can quickly make shares difficult to find. While the exact number of shares currently available to borrow is unknown, the 720% fee speaks volumes about the scarcity and the demand from short sellers. This high CTB means that short sellers betting against WLDS are incurring significant daily costs, increasing the pressure on them to see their thesis play out quickly. Squeeze mechanics explained. This brings us to the concept of a short squeeze. A short squeeze occurs when the price of a heavily shorted stock begins to rise. As the stock price increases, short sellers face mounting losses, especially if they're paying a high cost to borrow. At some point, the pressure becomes too great, forcing them to cover their positions. To cover, they must buy back the shares they borrowed and sold. This sudden wave of buying creates even more demand for the stock, driving the price up further, which then forces even more short sellers to cover, creating a positive feedback loop. It's a scramble for shares, forcing prices dramatically higher in a short period. Our internal composite squeeze score for WLDS, which combines factors like CTB, borrow supply, float size, and momentum, currently sits at 42.4 out of 100. This score indicates a noteworthy level of conditions that could lead to a squeeze, but is far from a guaranteed outcome. Dilution risk check. One critical factor to consider when evaluating a short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically reduces the value of existing shares because the company's earnings and assets are now spread across more shares. For a short squeeze thesis, dilution is a major concern because it can provide an ongoing supply of new shares to short sellers, effectively offsetting the scarcity that drives a squeeze. If new shares are constantly hitting the market, it becomes much harder for short sellers to be squeezed, as they can cover their positions or even initiate new ones without driving up the price significantly. For WLDS, we've checked recent SEC filings and found no recent dilutive SEC filings such as SMIN-S1s, SMIN-S3s, or 424BS in the last 90 days, nor any recent reverse splits. This is a positive sign for the squeeze thesis, as it suggests the existing share structure is stable. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should we be watching with WLDS? The most striking factor is the 720.0% cost to borrow. This implies strong conviction from short sellers, who are willing to pay a premium to maintain their positions, or a genuinely tight supply of shares. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It could also mean that short sellers are very confident in their bearish outlook and are willing to absorb those high fees because they anticipate an even larger drop. Chart WLDS volume. Today's volume for WLDS was only 38,036 shares, which is a stark contrast to its 30-day average volume of over 3.1 million shares. This extremely low relative volume indicates a very quiet trading day, which means there wasn't significant buying or selling pressure to test the short positions. For a squeeze to ignite, we typically need to see an increase in buying volume and sustained price momentum to start forcing shorts to cover. In summary, WLDS presents an interesting case study with its high 720.0% cost to borrow and relatively small 1.9 million share float. While the absence of recent dilution and reverse splits are positive, current low volume suggests a calm period. Keep an eye on the trading volume and price action to see if the pressure on short sellers intensifies. Remember, education is key to navigating these complex markets. If you found this breakdown helpful, please give this video a like, subscribe for more in-depth analysis, and let us know in the comments what stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.